Today we're going to talk about the Colby market timers, how they were developed, and how they've worked in the past. We're going to talk about why we need to time the stock market, how the market timers were developed and how they work, and how they've navigated past bull and bear markets. Here we have a chart of the S&P 500 index as measured by the exchange traded fund, ticker symbol SPY. If you bought SPY on 1/25/1993 when it was introduced and held it to the end of the last quarter, you would have an astounding gain of 1,530%. You did have to endure 2 bear markets, a lot of volatility, and big drawdowns. However, if you use the Colby market timers, you would have an even more astounding 2,298% gain with less volatility and smaller drawdowns. That's 50% more money. 50% more money, lower volatility. Big market trend changes are opportunities when we go from a bull market to a bear market or a bear market to a bull market. For an example, in 2008, the S&P 500 lost 56% of its value in just over a year. The people that say you should buy and hold and never sell say that, but it's easy to say, hard to do. It's hard to look at your life savings and lose half of it in a 1-year period. Similarly, in 1929, 1932, folks lost 89%. People say the market will always come back and to don't sell. Once again, easy to say, hard to do. Just because the stock market rebounded in 5 or 6 years, the last 2 bear markets, doesn't guarantee it'll do that again. It could take 10 years. It could take 20 years. If you can't wait 5, 10, or 20 years for the market to recover, what do you need to do? You need to time the market. Yes, you can. Not the everyday ups and downs, not the news stories you see on TV, not the articles you read in the newspapers, but the big, long, major trends. You can time them. We developed a system that gives us an early indication of a major trend change, and we call our system the Colby Market Timer. We offer market timers for 401ks, IRAs, and the U.S. government thrift savings plan called the TSP. With the Colby market timers, you will know when to get into the S&P 500 and when to get out. Our market timers are simple. They trade only about 3 times on average per year. We make many complex calculations back in the lab, then report to you on what changes to make in your accounts. The market timer is a complex mathematical algorithm. The computer output looks like this below. A lot of squiggly lines going above and below a green neutral line. We'll call the squiggly lines indicators. When the indicators on the chart cross the green neutral line downward, it's a signal to reduce our exposure to the S&P 500, that is, sell stocks and go to cash. Likewise, maybe after a bear market, the market's improving, the indicators are moving back up through the green neutral line. That's an indication for us to move back into the S&P 500 and reduce our cash position. It's okay to take on more risk. That's a complicated system. We're not going to ask you to interpret our indicators. So we're going to take our indicators and we're going to send you an email that looks like this. It'll show the percent of your account to put in the S&P 500 and the percent of your account to put into cash. You can see at the table below, there's a different row for each investor risk tolerance. If you don't know your risk tolerance, there's a link on each email so you can go develop your risk tolerance and then come back and use the correct row in the table. Here's another example. We're going to look at this area on our momentum chart on the left. It's after a bear market is subsiding and we're moving back into a bull market. We're going to take this period of time. We're going to send you an email that might look like this. Now we're 60% in the S&P 500 and 40% cash. And you can see the table below outlines each investor risk tolerance allocation as well. Now let's look back in history and take a look at how the market timers performed when there was a major trend change, bull market to bear market to bull market, and how long the buy and hold investors had to wait just to get back to even after a bear market. Here we see the 2008 bear market and then the subsequent bull market. The top chart are our market momentum indicators. The bottom chart is the S&P 500. The first rectangle here are when our indicators were telling us to sell. So we sold high, and that was in February of 2008. February of 2008. The S&P 500 fell 49% after that point, down to a low in March of 2009. Our indicators bought back in May 2009 and was 90% invested by August. This is still when people were shell-shocked by the financial crisis. The market timer got back into the market at actually a very nice point, which was 25% below where we sold. So we sold high and we bought low back when we bought back in when the market was more favorable. And in 2008, for the people who stayed the course, they didn't sell, it took them 5 years to get their money back. 5 years to get to where they just were in 2012, where they were in 2007. So no move forward. If you were retired and having to draw from those funds, it would have taken even longer to recover. I'm not going to go through all these charts. There's a lot of busyness on here, but you'll see the 2000-2003 bear market, very similar numbers. The market timer got out at a point 25% higher than when it bought back in. So it sells high, it buys low. 2000-2003, if you stayed the course like everyone tells you to do except us, you would have to wait 6 years to get back to even. 6 years just to get back to where you were in 2000. It would be almost 2007. Almost a lost decade. 1973-74, similar numbers. It took people 7.5 years to get back to where they were before the bear market occurred. And of course, we have to look at 1929 just for giggles. It wasn't very, people weren't giggling back then. The market timer got out at a point 63% above where it bought back in. And the people certainly weren't giggling after 1929. It took 25 years to get back to where they were before that bear market hit. In 2022, a bear market began. 2022 was a bad year for the stock market. The market timer started going to cash in February. It was halfway to cash in March, 90% to cash in May. The market continued down. The market has rebounded a bit, and the market timer has gotten back into stocks a little bit, 20 to 30%, but we're still hovering around that neutral line, and we will update this presentation as we move through this year. So these examples where we're showing you how the market timer sells high and buys low, that's what leads to this outperformance. That's what leads to having more money than just investing in the index alone. As we've shown, the market timer can save you thousands or millions of dollars depending on your situation. It can keep your retirement plan from collapsing. It can actually save your entire way of life, perhaps. We'll send you an email update every weekend with a market timer update. We've already shown you this. This is what part of the email looks like. There's more information in there. You reallocate your account if needed. You wait for next week's email, and you enjoy your week. So you have to ask, and you're probably wondering, what is this worth to you? It's worth a lot. But for a limited time, all of our market timers are free. Why are they free? We believe everyone in this country should have this information, so we're giving it to you for free. There's so much misinformation on the internet, on television, and in newspapers and publications that we're giving you this mathematics-based system for free. All you have to do is opt in. There are 3 links below to opt in. All of them are at our website, colbyassetmanagement.com. There's a 401k timer, an IRA timer, and a TSP timer link. So please go opt in. If you have any questions, write us at info@colbyassetmanagement.com. Thanks for listening and stay safe.